All right, you've probably heard this one before. It's one of the oldest, most famous sayings on Wall Street, right? This piece of financial folklore that basically promises a simple, easy path to beating the market. But the real question is, does it actually work? Okay, let's dive in and really unpack the truth behind what's called the Halloween indicator.
So, this is the big question we're tackling today. Is this time-tested piece of advice a genuine secret for juicing your returns? Or is it a dangerous myth that could actually cost you a fortune in the long run? We're going to follow the data on this one and just see where it takes us.
Now, here's something you might not know. The phrase Gretchen didn't even start on Wall Street. This right here, this is the original version, and it has absolutely nothing to do with stock charts or economic forecasts. Believe it or not, its roots are in the social calendar of 18th century British high society.
So let's just trace this journey real quick. Back in the 1700s, the wealthy London elite would just pack up and leave the hot city for their country estates all summer. And this mass exodus, it literally drained the market of its main players and, their capital. St. Leger's Day was a huge horse race in September, and it basically marked the end of their summer vacation and their return to the city and to the markets. Over the centuries, Wall Street kind of co-opted this idea, and eventually it morphed into the Halloween indicator we know today. Sell on May 1st, come back on Halloween.
Okay, so a quaint historical anecdote is one thing, but does any of this actually hold up when you look at the numbers? Well, let's get into it and look at the hard data, because this is where the story gets really, really compelling.
And wow, the numbers, they're pretty stark. I mean, just look at the Dow Jones going all the way back to 1950. The winter months, so November through April, have delivered an average return of 7.5%. The summer months, get this, a measly 0.3%. And it's a very similar story for the S&P 500. It's like almost all of the market's gains have been crammed into that winter window.
And this chart just makes it crystal clear. I mean, look at that difference. This isn't some small statistical quirk. We're talking about over 70 years of data showing a massive performance gap between the two halves of the year. The winter months have done all the heavy lifting, while the summer has been, for all intents and purposes, flat.
And don't for a second think this is just a Wall Street thing. A massive academic study dug into 300 years of data across 108 different countries, and they found the same pattern almost everywhere. This confirms it's a really robust global phenomenon.
Okay, so case closed, right? The data seems overwhelming. But this is where we have to talk about the billion-dollar catch. See, following this rule isn't as simple as it sounds, and there's a huge hidden cost that the averages just don't show you.
So let's run a little experiment. We're going to take two investors. Both start with $1,000 back in 1975. The first one diligently follows the sell in May rule, hopping in and out of the market every single year. The second investor? They just buy and hold, staying fully invested no matter what, through thick and thin.
So after nearly 50 years, our sell in May strategist turns that initial grand into a respectable $64,050. And look, on the surface, that sounds pretty darn good, but what about our other investor?
Our buy and hold investor, they end up with, wait for it, over $339,000. Yeah, that's more than 5 times the return. So what on earth happened here? This massive difference, that's the true cost of market timing. By trying to dodge the slow periods, you run the huge risk of missing the explosive, unpredictable upswings that really drive long-term wealth. In fact, studies have shown that if you miss just the 20 best trading days over the last half-century, your final return would be a tiny fraction of what a buy-and-hold investor made. It's true what they say. Time in the market really does beat timing the market.
So if following the rule is actually a bad idea, then why does the pattern even exist in the first place? It's a persistent anomaly, and it kind of challenges the whole idea of a perfectly efficient market. Let's dig into what the experts think is going on behind this strange seasonal behavior.
Well, there are a few main theories. One is about what you could call institutional gamesmanship. This is the idea that fund managers go for big risks early in the year, and then later on they play it safe to lock in their bonuses. Another theory is just pure psychology, cycles of optimism, maybe even things like seasonal affective disorder. But the most compelling theory, the one with some fascinating data behind it, is a bit more structural.
It's called the information density hypothesis. And the idea is actually pretty simple. The winter months aren't magical, they're just busier. They are structurally packed with more major corporate announcements, more regulatory filings, more shareholder meetings, all the stuff that actually moves markets.
And just look at this data point. Between November and April, companies file 473% more annual reports than in the summer. You also see way more SEC filings and insider trading activity. The winter is just where the action is, and that provides the fundamental fuel for higher returns, while the summer, well, it experiences a relative news drought.
But let's be real, the market of the 18th century, or even the 1980s, is nothing like the market of today. So the big question now is, can this ancient pattern really survive in an era of AI, passive investing, and high-frequency trading?
Today, something like 60 to 70% of all trades are executed by algorithms. And these machines, they don't take summer vacations. They process news in nanoseconds, and that basically eliminates the kind of seasonal lull that was caused by human traders leaving their desks. It fundamentally changes the whole rhythm of the market. And on top of that, think about passive investing. Billions of dollars automatically flow into the biggest companies, no matter what month it is. A perfect example was just last summer, in 2023. The old adage said sell, but the magnificent 7 tech stocks completely defied the pattern and drove the market up almost 9%, right in the middle of the so-called summer doldrums.
So where does all this leave us? Well, the pattern is real, but trying to trade it is a losing game. So this means we need to move beyond a simple yes or no verdict and build a smarter playbook for how to actually use this knowledge.
Here's a more nuanced approach. First, acknowledge the trend. The data shows there's a historical tendency for the summer to underperform. So second, instead of retreating to cash, think about rotating. This just means maybe shifting some money from cyclical stocks, the ones that do great when the economy's booming, into more defensive sectors like utilities or healthcare, which tend to be more stable. And third, always remember the tax man. Jumping in and out of the market triggers short-term capital gains taxes, which can seriously eat away at your return.
So here's the final verdict. Sell in May and go away should not be taken as a literal command to liquidate your portfolio. Instead, think of it as a historical observation and a really useful framework for thinking about managing risk throughout the year. It's a prompt to review your portfolio, not to run from it.
And that leaves us with a final thought to chew on. We know from history that the sell in May effect has been strongest in election years, mostly because of policy uncertainty. Well, looking ahead, 2026 is a midterm election year here in the US, which is typically the most volatile of the whole 4-year cycle. So how will today's modern, machine-driven markets react when they're faced with one of history's most powerful seasonal headwinds? Now that is a question worth watching.